Steve, welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
Janine. This podcast is brought to you by Real Approved Incorporated, a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Steve, first up on today's docket, we're discussing why Canadian fixed mortgage rates are rising again. After briefly dipping below 4%, most 5-year fixed mortgage rates at Canada's major banks are back above the 4% mark. Experts suggest they could stay elevated for some time. Janine, what's your take on this?
Janine. Well, Steve, it's definitely a concern for many homeowners and prospective buyers. Just 2 months ago, rates fell sharply due to a plunge in bond yields driven by U.S. tariff concerns. Now we're seeing an increase again because Canada's 5-year fixed mortgage rates are closely tied to the country's 5-year bond yield, which is influenced by the U.S. 10-year Treasury. It's fascinating how global forces can impact our local rates.
Steve, absolutely, Janine. Bruno Valco, Vice President of National Sales at RMG, pointed out that what influences the 5-year Government of Canada bond is not always what's happening in Canada. Often, it's the yield on the 10-year U.S. Treasury that plays a significant role. In early April, the U.S. 10-year Treasury dropped below 4%, but has since climbed back above 4.5%, pushing Canada's 5-year bond yield from about 2.5% to 2.85%.
Janine, and with that rise in bond yields, we've seen banks like CIBC and RBC raise their 5-year fixed rates by about 10 basis points. TD hiked select terms as well, increasing its 3-year rate by 10 basis points and its 5-year fixed rates by 15 basis points. Interestingly, Scotiabank is going against the trend and has lowered several of its posted special rates and eHome digital rates.
Steve, that's right, and it's not just about the numbers. The bond and mortgage markets are influenced by developments in the U.S., economy, and how investors interpret them. Valco mentioned that factors like inflation, interest rates, employment, and investor confidence in the economy all play a part. For instance, the 10-year Treasury yield jumped after reports that inflation had cooled in the U.S., sparking speculation of a rate cut later this year.
Janine, it really highlights the interconnectedness of global economies, doesn't it? Valco also mentioned concerns about stagflation in the U.S., where high inflation and stagnant economic growth coincide with high unemployment. While it's not a certainty, it's a factor that could influence investors' decisions and, in turn, affect Canadian mortgage rates.
Steve, exactly, Janine. Market volatility south of the border means forecasts come with a degree of uncertainty. Valco advises risk-averse mortgage buyers who can afford the current rate to consider a 5-year fixed product for the peace of mind that comes with a consistent payment schedule. But as always, it's essential to stay informed and weigh all options carefully.
According to recent data from ratehub.ca, Canadian homeowners who are renewing their 5-year mortgages this year are facing a significant increase in their monthly payments, with a jump of around 15%. This is happening amidst a noticeable decline in new home purchases. The report highlights that new home purchase inquiries have dropped to 47% of mortgage rate searches, down from 71% at the same time last year. Meanwhile, renewal inquiries have surged to 39% from 22% in 2024.
That's quite a shift, Janine. Penelope Graham from ratehub.ca mentioned that fewer Canadians are looking to purchase homes due to the rocky economic climate. At the same time, the number of mortgage terms coming up for renewal has increased significantly. With today's interest rates being much higher than they were in 2020, borrowers are becoming especially rate motivated. It's a challenging time for many homeowners who are trying to manage these higher costs.
Absolutely, Steve. The Bank of Canada's 2025 Financial Stability Report notes that 60% of all outstanding mortgages in Canada will renew this year and next. Most of these will face payment increases due to the higher interest rates. For example, a homeowner who bought a house in 2020 for $488,000 with a 10% down payment and a 5-year fixed rate of 2.14% would have paid $1,948 monthly. Upon renewal in April 2025, with a new rate of 3.74%, their payments would increase by $300 a month or $3,600 annually.
That's a substantial increase, Janine. It's not surprising when you consider that national home sales have also declined dramatically, hitting a 16-year low in March. RateHub.ca attributes this to tariff-induced economic uncertainty and growing fears of a recession. It's a tough environment for both buyers and sellers right now.
Indeed, Steve. There are other trends worth noting as well. Variable rate mortgage inquiries have risen slightly to 8% from 5% last year, influenced by the Bank of Canada's rate-cutting cycle that began in June 2024, which lowered rates by 225 basis points. While fixed rates remain dominant, they've decreased to 77% of inquiries from 83% in 2024. There's also been an increase in 3-year fixed-term inquiries, which have gone up to 12% from 7%, reflecting a borrower preference for flexibility. And refinance inquiries have doubled to 12% from 6% as homeowners seek relief from financial pressures.
It seems like homeowners are exploring all possible options to manage their finances in this environment. Penelope Graham also pointed out that this renewal wave is expected to accelerate in the coming months. Even though today's lowest 5-year fixed mortgage rate of 3.84% is lower than the peak of 5.49% reached in October 2023, it's still significantly higher than the 2.14% rate available in May 2020. It's a reminder of how quickly the market can change and why it's important to stay informed and adaptable. Steve, next on our agenda, we're turning our attention to Toronto's real estate market, which has shifted dramatically from the frenzied bidding wars of yesteryears to a more buyer-friendly environment. Recent data indicates that 66% of homes in Toronto sold below the asking price in April, marking the highest percentage for the month in over a decade. Homes were sold at an average of 98% of their list price, which is the largest discount seen in April since the pandemic began.
Janine, that's quite a change, Steve. It seems like the tables have turned in favor of buyers, especially during what is traditionally the busiest time of the year for real estate transactions. The economic uncertainty, largely driven by a global trade war initiated by the United States, has certainly played a role in this dynamic. With more listings hitting the market, buyers have more options and sellers are feeling the pressure to adjust their prices.
Steve, indeed, Janine. The Royal Bank of Canada has noted that Toronto's housing market is now more favorable for buyers than it has been since the 1990s, a time known for steep price corrections. The benchmark home price in Toronto fell by 5.4% year over year to $1.01 million in April, and home sales were at their lowest in 30 years, excluding the pandemic period. Robert Hogue, an economist at RBC, mentioned that the ongoing trade war has made many potential buyers hesitant to commit to large financial decisions.
Janine, and I can understand why, Steve. When there's so much uncertainty in the air, it's natural for people to be cautious about making big purchases. But for some families, waiting isn't an option. Take Vienna Waddell and her husband, for example. They needed more space for their growing family and had to sell their condo on Toronto's lakeshore to move into a 3-bedroom bungalow in the suburbs. Unfortunately, they had to accept $50,000 less than their asking price to make it happen.
Steve, it's a challenging situation for sellers, Janine. Tom Story, a Toronto real estate broker, observed that many buyers are now submitting offers at least 5% below asking prices and are ready to walk away if sellers do not show flexibility. He mentioned that some sellers are still resistant to these lower offers, but buyers are willing to move on to other options if necessary. It's a clear indication of how the market dynamics have shifted.
Janine, absolutely, Steve. It's a testament to how the market is evolving. Buyers are clearly in a stronger position than they have been in recent years, and sellers are having to adjust their strategies to meet this new reality. It will be interesting to see how this plays out in the coming months, especially if economic conditions continue to fluctuate.
Steve, let's delve into the latest legislative development in Ontario that's causing quite a stir. The province has introduced the Protect Ontario Through Free Trade Within Canada Act, 2025, also known as Bill 2. This bill aims to ease the movement of realtors across provincial borders within Canada. The legislation has already passed its second reading. However, there's a growing concern that this could potentially lower the high standards that Ontario's real estate sector is known for.
Janine, that's right, Steve. The core of the concern seems to be that realtors from provinces like New Brunswick and Nova Scotia could start working in Ontario without having to pass an exam specific to Ontario's regulations. They would simply apply with their current certification and, upon approval, could begin working here. This has raised alarms among some Ontario realtors who worry about the implications for consumer protection and market knowledge.
Steve, exactly, Janine. Danny Dawson, a real estate agent who operates in both Ottawa and the Outaouais region, expressed his concerns about the lack of a rigorous process to ensure these incoming realtors are well versed in Ontario's specific rules and regulations. He argues that without a proper system in place, the high standards expected by consumers might not be met.
Janine, and it's not just about knowing the rules, Steve. Realtor Scott Ingram from Toronto highlighted how even within Ontario, market customs can vary significantly. He recounted his own experience of adjusting to different practices when he moved his operations from Toronto to Port Hope. The diversity in local practices can be a challenge for realtors who aren't familiar with them, potentially leading to complications in transactions.
Steve, that's a valid point, Janine. The bill is part of a broader push by Ontario Premier Doug Ford to remove trade barriers across provinces. The idea is to standardize processes across Canada, but real estate is more complex than other trades, as it heavily involves consumer protection and significant financial transactions.
Janine, yes. And while the goal of easing interprovincial trade is commendable, the real estate sector requires a delicate balance. Kathy Poland from the Ontario Real Estate Association mentioned that they are collaborating with the government to evaluate the bill's impact and ensure a smooth transition. It's crucial that consumer protection remains a priority as these changes are considered.
Steve, indeed, Janine. Matthew Thornton from Real North Strategies pointed out that despite the bill, realtors will still need to comply with Ontario's Trust in Real Estate Services Act. He believes that this will help maintain the standards, as real estate transactions are sensitive and involve life savings. He doesn't foresee standards dropping as a result of this bill.
Janine, that's reassuring to hear, Steve. Ultimately, some industry experts like Dawson and Ingram don't believe the bill will lead to a large influx of out-of-province realtors. The financial and logistical challenges of working in multiple provinces might deter many from taking advantage of the new legislation. The current process, which includes taking an exam, is not seen as a significant barrier, and few realtors currently choose to operate across provincial lines.
Steve? Right, Janine. It seems that, while the bill aims to facilitate trade and labor mobility, the real estate sector might not see dramatic changes. Nonetheless, it's a development worth monitoring as the province works on implementing the bill's regulations and gathering input from industry stakeholders. Steve, in our final segment today, we're diving into a significant regulatory development involving Razer Capital Corporation. The Financial Services Regulatory Authority of Ontario, or FSRA, has imposed an administrative penalty of $15,000 on Razer Capital. They've also issued a compliance order for the company to cease and desist administering mortgages in Ontario. Janine, what are your thoughts on this action by FSRA?
Janine, it's a critical reminder of the importance of compliance in the mortgage industry, Steve. Razer Capital was found to be administering mortgages without the necessary license, which is a direct violation of Section 5.2 of the Mortgage Brokerages, Lenders, and Administrators Act, 2006. The FSRA's decision to impose both a financial penalty and a compliance order underscores their commitment to protecting consumers and maintaining the integrity of the financial services sector.
Steve, absolutely, Janine. It's crucial for companies in the financial services industry to adhere to regulations to ensure consumer trust and market stability. Razer Capital's decision not to request a hearing or contest. The FSRA's proposal suggests they might be accepting the penalty and compliance order without dispute. This could indicate an acknowledgement of their oversight or a strategic decision to avoid further legal entanglements.
Janine, that's a good point, Steve. The FSRA's actions serve as a reminder to all mortgage administrators and brokerages about the importance of maintaining proper licensing. It's not just about following the rules, it's about safeguarding clients' interests and ensuring that the industry operates fairly and transparently. For consumers, this enforcement action by FSRA reinforces the importance of working with licensed professionals when navigating the mortgage landscape.
Steve. Right, Janine. The FSRA plays a vital role in monitoring and enforcing compliance within the financial services industry. By taking swift action against Razer Capital, they demonstrate their dedication to consumer protection. It's a clear message to all entities operating in this space that non-compliance will not be tolerated.
Janine. Exactly, Steve. For anyone interested in learning more about FSRA's enforcement activities, they can access their enforcement database, which provides insight into how the FSRA is working to protect consumers. It's a valuable resource for understanding the regulatory landscape and the measures in place to hold companies accountable.
Steve, thanks for tuning into another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Janine, before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.